Warren Buffett just did something that's making some people worry if we're at risk for a crash. You've probably seen some of the headlines. Buffett heads into 2025 with the biggest cash position in more than 30 years. The not so subtle warnings for Wall Street. And is this bad news for Wall Street? And what they're getting at here is that Buffett's Berkshire Hathaway is sitting on a record $280 billion in cash. That's up from $190 billion just a few months ago, which is a 50% increase in a pretty short amount of time. And because we've been helping people retire over the last decade and a half, some of our clients, they'll come to us and say, well, this is Warren Buffett. Does he know something that we don't know? Should we be worried about something? Should we be moving to more cash? So today I'm going to share why he's doing this and then what you should do if you're thinking about your retirement more than ever now and thinking about your portfolio as you move into this year. There's really 3 specific things that I do recommend that you do this year, and I'll share that in this video coming up. And this video is going to give you a plan to help you get more confidence this year with what you're doing with retirement and finances and anything money related. But before I dive into the details, let me be clear. I'm a huge Warren Buffett fan. I've studied his investment philosophy for years. I've helped hundreds of retirees at Streamline Financial build their retirement plan using a lot of the same strategies and his core principles. But there's something that people are missing about Buffett's recent moves. Let's look at some of the numbers first here. The current cash position for Berkshire Hathaway is around 30% of their total assets. Now, historically, it's been around 13% in cash. So yes, they've been holding more cash than usual. But what those headlines, they don't say is despite the massive cash position that they do have, Berkshire, it still has roughly $350 billion invested in stocks. So they're not abandoning the stock market. They're really being selective with what type of investments they're going to hold. Not too long ago, a couple brought up Warren Buffett and Berkshire's cash position and the balance, because there's always these articles, very similar headlines out there. And they read some of them and they were wondering, well, if Warren Buffett is worried, should we be worried too? And this led to a really important conversation about the 3 big differences between Warren Buffett and Berkshire Hathaway and your retirement portfolio or this client's portfolio. And the same does apply to you. Well, let's get into it, because first, Berkshire Hathaway, it's primarily an insurance company. That's number one. They need a large amount of cash on hand because there are potential insurance payouts they'll have to pay out. Buffett himself said that they need at least $30 billion in cash reserves for just insurance obligations, just for that piece of the business. And some analysts suggest that they actually need closer to $80 billion, I believe, for this purpose alone of just insurance. Because if there's a major natural disaster, then they've got to be ready and they have to have the cash on hand for billions in claims. In 2017, the major hurricane resulted in a little over 130 billion in insurance claims industry-wide. So that's why insurance companies, they need this large cash reserve. Now, you and your 401k, you don't have to worry about insurance payouts, right? You've got other risks to worry about that could impact your 401k. But those things can be mitigated. And I'm actually planning on recording a video on the major retirement risks that we should be aware of moving forward and how to mitigate them. So if you're interested in that, let me know by giving this video a like or saying something in the comments so that I know that it would be helpful for you. The second big difference here is when Buffett or Berkshire wants to invest, they need to pretty much buy entire companies or make billion-dollar investments for it to make a meaningful impact on Berkshire Hathaway's bottom line. The company is so big that they're limited to what companies they can buy. As an example, this $900 billion company, Berkshire, buying $1 million worth of stock would be like an average millionaire investing $1.70 in some sort of investment. So it doesn't really move the needle. And that's why Buffett needs to wait for really big opportunities. But with your retirement account, you can invest in any company with any amount pretty much at any time that makes sense for you. You've got more flexibility and opportunity than that big company, Warren Buffett's company, does. And then third, this is an important one. Buffett's running a huge conglomerate with different goals, different timelines, and different responsibilities than what you're doing. His company is pretty much designed to last forever. And your portfolio, the main thing we want to do is have it last 20 or 30 years, as long as you're alive. So they can afford to wait years and years for the perfect opportunity. And you most likely need your portfolio working for you now. So it doesn't make sense to copy what Warren Buffett's doing, because you wouldn't copy Arnold Schwarzenegger's workout routine if you're just trying to stay healthy in retirement. So it doesn't make sense to copy Berkshire Hathaway's cash management strategy when you're just trying to maintain a comfortable and a predictable retirement income. It kind of reminds me of another client in March of 2020. Mike was fearful of what was going on. It's not just a health scare that happened. It was a financial scare as well in a really short amount of time. And he watched a really well-known hedge fund manager get on CNBC and really speak major doom and gloom and how we're going into the next depression, and predicted that things were going to get way, way worse. And it would have been so easy for Mike to go more conservative. But our clients, they did something different. They followed the same streamlined investment system we've been following for years. And they were proactive, and they rebalanced, and they actually moved more into equities for what made sense for each individual or couple. And it didn't jeopardize their income plan. And then a few months later, we actually had to do the reverse because things came back so quickly that they had to rebalance again and get back to the normal pace that they were at. But now let's talk about what this means specifically for you. It's another three things. One, Berkshire's got a goal and you've got a goal. And one goal for you, as we said, is provide predictable income to you, regardless of the ups and downs in the market. So step one is to create your retirement income plan first. Because once you create the income plan, that tells you how much you should have in stocks, bonds, or any other investment. It's kind of the income plan tells you what the investment plan needs to be. And that's part number two. That once you've got the income plan, it will tell you what the rate of return needs to be. We find that many clients, once they create the income plan, find out the rate of return, they can actually lower their risk a lot more and still have a very high chance of success in retirement, of the plan working out. And then number three, consider the bucket strategy. After you've got the allocation and the rate of return, then you could kind of, don't pay attention to the amounts here, but then you could kind of decide how much are we going to have in short-term assets that are not going to fluctuate as much when the market's going up and down. This is kind of the ballast of the portfolio. That's the thing to rely on when things go haywire. For example, are you able to keep enough cash for 2 to 3 years of expenses? If you had to spend $60K out of investments every year, could you have 120 to 180K in cash? And the reason why we think this way is because when we zoom out and look at what the average bear market has done since 1926, we can see that it's lasted approximately 1.3 years. So by keeping enough cash in your portfolio or in your accounts, you can outlast some of the market downturns and avoid being forced to sell investments when they're at low prices. Now, again, not everyone can do this with amounts of cash. So it's important to talk to your financial professionals and see what makes the most sense for you. But here's one more very important point. This could mean the difference between hundreds of thousands of dollars in your retirement savings. Because according to Dalbar's study, over the past 20 years, we can see that the S&P 500, or let's take the 60-40 portfolio, has done an average of 6.4% per year, but the average investor here has done just under 3% per year. And a lot of that has to do with making the wrong decisions at the wrong time versus following a systematic investment plan that's really following the weighty evidence of history. And as we get back to Warren Buffett, in this cash position that he has in Berkshire Hathaway, he said in 2013, his letter to shareholders, he revealed that his own personal family plan, if he could have it his way, what he would do, he would take 90% of whatever gets passed on to kids and put that into index funds, really the S&P 500 index funds, not hold it in cash. Again, there's personal things we need to plan for. And then there's these big businesses, hedge funds or conglomerates, they plan a different way. So it probably doesn't make sense to model what these big companies are doing. But again, important to talk to your CFP, make a plan specific to you. And then remember, your retirement success, it doesn't depend on timing the market, going in and out of cash, or copying billionaires or hedge funds and their strategies. It depends on having a solid plan built on the weighty evidence of history and just sticking to it. If you think this would be helpful for other people who are maybe see these headlines and get worried about things, please click the like button and then, or send it to a friend of yours. And then I'll see you in the next video that I'll put up here. Take care.